Consistency is the one thing every trader says they want, and the one thing almost none of them can hold on to. They have a good week. They feel unstoppable. They increase size. They loosen rules. They take trades that were never part of the plan. Then the market pulls back. A red day turns into a red week. Confidence disappears. The strategy that worked suddenly feels broken. They tweak it, adjust it, replace it. They blame volatility. They blame news. They blame manipulation. They blame everything except the one thing actually breaking their results. Meanwhile, a small group of traders stay steady, almost boring. Same position size, same rules, same hours, same routine, same charts, same markets, same opportunities. So what's the difference? It's not intelligence. Some of the smartest traders still struggle to stay consistent. It's not strategy. Many traders use profitable systems and still can't follow them. It's not capital. You can have a small account or a large one. The emotional swings look the same. It's not access to information. We all see the same price action. The difference is this. Most traders trade based on how they feel. A few trade based on what they decided in advance. One group reacts, the other repeats. Today, we're going to break down why consistency feels so hard in trading, why you can execute perfectly one week and completely lose control the next, and what separates traders who stay steady from those who keep starting over. By the end of this, you'll understand why your results swing even when your strategy doesn't, and more importantly, what actually needs to change if you want consistency to stop feeling impossible. Part 2. The hidden forces breaking your consistency. Let's start with two traders. Ryan had a solid strategy. He'd backtested it. He knew the win rate. He knew the risk to reward. On paper, it worked. The problem wasn't the system. The problem was him. After 2 losses in a row, he'd hesitate on the third trade. After 3 wins, he'd double his size because he felt in sync with the market. Some days, he followed his rules perfectly. Other days, he ignored them completely. His equity curve looked like a heartbeat monitor. Up, down, no stability. Now meet Daniel. Same market, similar setup. Same risk per trade every single time. He didn't increase size after a win. He didn't shrink from a loss. He didn't need to feel confident to execute. He only needed his setup to appear. Over time, their results looked completely different. Not because one had a better strategy, because one had control, and the other had emotion. So why is consistency so hard to maintain, even when you know what to do? The first force is emotional volatility. Trading amplifies emotion faster than almost anything else. A small win feels like proof you've figured it out. A small loss feels like evidence you haven't. Your brain attaches meaning to short-term outcomes. You start believing the last trade says something about you. When you win, you feel capable. When you lose, you feel flawed. That emotional swing pushes you to adjust behavior. You trade bigger when confident. You hesitate when doubtful. Consistency collapses because your execution is tied to your mood. The second force is dopamine. Trading gives instant feedback. Every tick is movement. Every candle is information. Every closed trade is a hit of reward or disappointment. Your brain starts chasing that stimulation. You take trades not because your edge is there, but because doing nothing feels uncomfortable. Boredom becomes unbearable. You convince yourself that activity equals productivity, but consistency requires restraint. It requires sitting still when nothing aligns. Most traders don't break their rules because they don't know them. They break them because waiting feels harder than acting. The third force is short-term memory. Bias. You overreact to the last 3 trades as if they define your entire strategy. A losing streak feels permanent. A winning streak feels sustainable forever. You forget that probability only plays out over large samples. Instead of thinking in blocks of 50 or 100 trades, you think in blocks of 1 or 2. You tweak after a bad day. You add filters after a losing week. You remove rules after a drawdown. Every small fluctuation becomes a reason to change something. But consistency requires stability. If the rules keep moving, your results will too. The fourth force is the illusion of perfection. Deep down, many traders believe that if they just refine their system enough, losses will disappear. So every time a trade fails, They assume something must be wrong with the method. They adjust entries. They widen stops. They add indicators. They switch time frames. The goal quietly shifts from executing a profitable edge to eliminating discomfort. But no system removes losses. Inconsistency begins the moment you start trying to trade without friction. The fifth force is lack of structure. Most traders say they have rules. Few have structure. They trade different hours each day. They risk different percentages depending on conviction. They sometimes take 5 trades, sometimes 15. They don't have a defined daily routine. Without structure, emotion fills the gap. Without limits, impulses expand. Consistency isn't just about having a strategy. It's about having boundaries that don't change when you do. These forces don't mean you're incapable. They mean you're human. The difference between inconsistent traders and consistent ones isn't that one group feels nothing. It's that one group builds systems strong enough to survive their own psychology. Part 3. The shift from emotion to structure. Here's the part most traders miss. Consistency doesn't come from trying harder. It doesn't come from more motivation. It doesn't come from watching another psychology video after a bad week. Consistency comes from structure. And structure is uncomfortable because it removes flexibility. It removes the freedom to act on impulse. It removes the emotional wiggle room that most traders secretly rely on. The first shift is simple but difficult. Stop measuring your trading day by profit or loss. Start measuring it by execution. Did you wait for your setup? Did you risk the same percentage you always risk? Did you exit where you said you would? If the answer is yes, the day was successful, even if you lost money. That single change stabilizes your emotional state. You are no longer at the mercy of random outcomes. You are anchored to behavior you can control. Over time, that anchor is what creates smooth equity, not emotional reactions to short-term noise. The second shift is to zoom out. Most traders think in days. Some think in weeks. Very few think in samples. If your strategy has a tested edge, its results only make sense over a large number of trades. 10 trades mean nothing. 20 trades mean very little. But 50, 100, 200 trades begin to reveal truth. When you start thinking in sample sizes instead of single outcomes, the pressure disappears. A loss is no longer a verdict. It's just one data point. And data points do not require emotional response. The third shift is to remove decision fatigue. Consistent traders reduce variables. They trade the same sessions. They watch the same pairs or instruments. They risk the same amount every time. They don't negotiate with themselves in the moment. The rules were decided when they were calm, not when money was on the line. Inconsistent traders decide in real time. And real-time decisions are always influenced by emotion. The more decisions you leave open, the more inconsistency you invite. The fourth shift is to embrace boredom as part of the strategy. Doing nothing is a position. Waiting is a skill. If your setup doesn't appear, the correct action is no action. This sounds simple, but it goes against the instinct to be productive. Many traders equate movement with progress. They feel guilty closing the platform without taking a trade. But discipline often looks like inactivity. The traders who last are not the ones who trade the most. They are the ones who trade when it actually makes sense. The fifth shift is identity. As long as you see yourself as someone trying to win, your behavior will fluctuate with results. But when you see yourself as someone who executes rules, the outcome becomes secondary. You are no longer chasing validation from the market. You are following a plan you designed. That shift removes ego from the equation. You don't need to feel right. You only need to be consistent. Think about this. Imagine limiting yourself to a fixed number of trades per day. Imagine risking the same amount no matter what happened yesterday. Imagine closing your charts when your conditions are not present, instead of searching for something to justify a trade. At first, it feels restrictive, almost boring. But over time, something changes. Your equity stops swinging wildly. Your stress levels drop. You begin to trust your process instead of your emotions. That's when consistency starts to build. Not because the market changed, but because you did. Part 4. The identity of a consistent trader. Here's the boring truth no one likes to hear. Consistency is repetitive. It is not dramatic. It is not exciting. It does not feel like you are crushing the market. It feels like doing the same thing over and over, while everyone else is chasing something new. You wake up, you analyze the same way, you wait the same way, you risk the same amount, you close the trade where you plan to close it. Then you repeat it tomorrow. There are no emotional highs. There are no heroic comebacks. There is just steady execution. That is exactly why most traders struggle with it. Not because they are incapable, not because the market is too complex, but because consistency demands patience, humility, and restraint. It exposes ego. It forces you to admit that you cannot control outcomes. It asks you to give up the idea of being brilliant and replace it with being disciplined. And discipline is quiet. It doesn't impress anyone. It doesn't give you stories to brag about. It gives you stability. Inconsistent traders chase feeling. They feel confident, so they push size. They feel scared, so they hesitate. They feel bored, so they force trades. Their behavior shifts with every emotion. Consistent traders operate differently. They trade the same whether they feel good or bad. They follow the same rules after a winning streak and after a losing streak. Their identity is not built on being right. It is built on repeating a process. When you look at steady equity curves, they are not built from one brilliant week. They are built from months of controlled behavior. Small risk, defined. Rules, limited trades. No emotional adjustments. It sounds simple because it is simple. But simple is not easy. Simple requires control. At some point, every trader faces a choice. You can continue chasing consistency as if it is something the market gives you, or you can accept that consistency is something you build by limiting yourself, by committing to structure, by accepting boredom, by letting go of the need to feel in control of outcomes. The market is not the unstable element in your trading. Your behavior is. When behavior stabilizes, results begin to stabilize. Not instantly, not dramatically, but gradually. And gradually is enough. If you want consistency, stop looking for a better system and start becoming a steadier operator. Keep following the channel as we share more other insights, trading stories, and trading motivation tips in the future videos.